Well, as markets start to factor in the rising cost of capital and possibilities of a recession, some say the volatility creates opportunity. Let's get into that and where those opportunities lie. Marc Wait is joining us from Providence Wealth Advisory Group. Marcus, good to see you.
Morning, Andrew.
Well, have we seen a perhaps distinct lack of volatility given what's been going on at the moment? And are you expecting volatility to increase from this point on?
Well, I think it really depends on your perspective in terms of time. So what we were doing in terms of our third quarter sort of outlook for Providence was really reflecting what happened during the third quarter of this year. And I think there was indeed a lot of volatility. You saw 10-year bond yields move from below 4% towards 5%, significant tightening in financial conditions, equity markets derating, so price to earnings ratios coming down, and a little bit of volatility in the sort of equity in the currency markets. And against that, you saw quite a strong bid in terms of safety assets like gold.
All right, so what are you seeing ahead then? Because as we know, that volatility does create that trading opportunity.
Yep. So the things that we've been doing with our portfolios, and we think there's quite a lot of interesting opportunities at this point in time. If we start with the equity markets, you've seen a very sort of narrow rally for much of this year in terms of the equity markets. So there's been parts of the markets that have been left behind. So as we saw that volatility during the third quarter, we took the opportunity to allocate towards mid-cap global equities, where we thought valuations were quite attractive compared to the larger caps. And indeed, there was a fair bit of sort of bad news priced in. I think the second thing is, if you look at the interest rate markets, there was a lot of fear during the third quarter about who's actually going to buy bonds going forward. And I think it was a very, very sort of focus that potentially bond yields were going to move to 6, 7% at one point in time. And we felt that what was really interesting is if you look across the whole sort of capital structure, the yield in credit instruments is substantially above what you can achieve in equities at this point in time. So there's actually some very interesting opportunities there.
Just before we get into that, sticking with equities, regionally, where are you seeing opportunity at the moment?
So the regional focuses for us, as we've spoken to before, we quite like Japan, and there we have an activist manager where we're taking advantage of corporate change, and we continue to think that that market's attractively priced. If you look at the topics, that's trading a little bit above 13 times PE compared to the S&P at closer to 18 times. And there's quite a lot of activist movement there. So you're seeing a lot of companies that have got listed subsidiaries, having them closed down. Indeed, yesterday there was a company called Fujisoft that did that. So there's been a lot of momentum in that strategy.
All right, so let's then turn to credit and the opportunities seen there. And also just in terms of, you talk of harvesting yield. How are you doing that at the moment?
Yeah, so I think that's a great question. So I think there's really sort of a number of ways in which we're doing that. So if we look at sort of fixed income and having had a large repricing of fixed income, if you look at investment grade credit hedged back into Australian dollars, we've started to increase our allocation from a very significant underweight position. So we're looking at good managers in that space can achieve portfolios of around about 5.5%. And because of the size of the yield in that market now, there's a fair bit of protection from sort of future volatility. The second part is if you look into the sort of deeper credit markets, being high yield and private credit, there's opportunities there, but you have to be very selective around the types of managers that you choose. And really what you want to see is managers who've got multiple cycles of experience in lending, and second of all, really good experience in working through the difficulties. Because there's a reason that you're getting paid 9, 10, 11, 12%. So you need a manager that can manage through those difficult periods. And indeed, that was something that I saw firsthand when I previously worked for a sovereign wealth fund and was managing through sort of the aftermath of the global financial crisis and some of the distressed credits there that we were working through in that period afterwards.
So is it your expectation that that distressed credit is going to grow, and what opportunity does that present?
Yeah, so I think if you look at distressed credit earlier this year, we made an allocation to a manager in that space as well. And we feel as though particularly the sort of epicenter of this sort of change in interest rates has been good companies with the wrong capital structure. So that gives an opportunity for a distressed credit manager to take control of that company, particularly in an environment like the US, where that's easier to do in the legal environment. And I think the second thing is the sort of real estate market. So this week we've had some really interesting news around WeWork. Historically, its share price was above $500. I think yesterday when it stopped trading, it was 80 cents. And you look at the sort of capital destruction in that space, and you look at the environment, it's a difficult environment. And you can see that in the US, you've got 20% vacancy in the New York office market, above 30% in San Francisco. But I think, as we always know, there'll always be particular opportunities in that environment.
What risks do you need to be aware of, and how do you mitigate those risks?
Yeah, so I think you need to have a very long-term horizon in terms of investing in a distressed credit manager. So typically when you invest in that space, the money will be in a fund that might be locked up for anywhere between 8 and 10 years. I think the second thing is, much like in the private credit space, you want to make sure that you have a high quality manager who's proved that they're adept at actually being able to take control of companies through the debt structure. And I would say actually from all of the sort of due diligence that we've done, there's probably only around about 4 or 5 managers in the world that have multiple cycles of experience in that space and the credibility to invest with.
Marcus, overall, when you look at what's going on at a macro level, but also geopolitics, given we've got the issue obviously unfolding in the Middle East at the moment, how do you position for that?
Yep. So I think if you look at something like gold in Australian dollar terms, and that will move down from one day to the next, and indeed it's come back a little bit the last couple of days, but I think it's really sort of proved its worth. So as we saw the Israeli-Hamas war, you saw the gold price move up towards $2,000 an ounce in US dollar terms, and it really provided quite a nice diversification balance and flight to quality balance within portfolios. I think the second thing is making sure that you've got adequate degrees of liquidity in portfolios, because it's these moments where volatility creates opportunity that you can actually put money to work and take advantage of some of those volatility in that space. And then the third thing I think that's important is fixed income's had a really tough time. It's had a really sort of tough couple of years. This year was meant to be the year of the bond and it hasn't quite come true yet. Last year was very difficult. But we do think that as we get to these high levels of yields, real yields at sort of 2.25%, fixed income can start to play a little bit more of a balancing item in portfolios.
Are you seeing perhaps more opportunity offshore rather than in Australia then?
I think that's absolutely right. So recently we've made an allocation slightly away from Australian equities and towards international equities. And that's really based on sort of the concentration of the Australian market, where it's dominated by banks and mining companies. And second of all, I think if you look at the valuation, whilst the Australian valuations aren't egregious, they are sort of middle to upper end of the range of markets around the world, and you can see better value in markets like Japan or in global mid-caps.